Yo, what up, YouTube? This your boy Leo. Welcome to Stack and Grow Capital, you heard me? Listen, I'm gonna give y'all a treat. In this video, I'm gonna explain the difference between stock options and buying stocks. A lot of people always ask me that question, so I wanna make sure y'all get an understanding. And if you trade options and you're struggling, I'm gonna tell you what you need to do so you can start making you some profits, you dig? So when it comes to stock options, you are buying option contracts, and contracts control 100 shares. So you can buy one contract and control 100 shares. When you buying stock shares, you're only buying one share, just one. And because an option contract control 100 shares, you have to multiply that price, because it's only quoting one share, you have to multiply that price by 100. Okay, now I'm gonna break this down for you even further. When selecting a stock option, you first must look at the chart. Depending on your setup or your pattern, then you look at the strike price. This is my strike price right here, 365, or 367.5, 370. Everything right here could be a strike price, you dig? So I'm saying if it get above 365, it can go up to 367. That's a $2 move. That's an amazing move when you trade stock. Every time the market move $1, you could profit up to $100, you dig? I was waiting for the market to break 364 though, but it never broke that level. You see, it kept wicking that level, it never broke above. So that let me know this is an important level. I just need the market to break above 364, you dig? Now, if I go to my option chain and I wanted to buy that contract, first thing I need to do is look at my strike prices. These are all my strike prices. Then I'm looking at the expiration date. How much time do I need for this contract to expire? Then I'm paying a premium price. We don't pay the share price in options, we pay the premium price, you dig? So I'm looking on this chart, they don't have a 364, but they have a 365. I'll take that trade. Now here's the problem. In this example, the market is closed, so these prices are off. When the market opens, these prices will adjust. This 365 price, say 3 cents. That is incorrect. When the market opens, this contract would be about $2, maybe $3. Let's say $3 for example, because Tesla is one of the more expensive stocks. So if it was quoting $3, I would have to multiply those $3 by 100. That would cost me $300 to buy the stock option contract. So I'm paying $300. For 365 to 367 is a $2 move. Really 367.50. That's a $2.50 move. So you'll make about $250. Because each option earn you about $100 every time the market move $1, you dig? Now if you keep going, that's even more money. But I think you get my point about option contract versus shares. Because if I wanted to buy a share, I would pay this price right here, $364.49. I will pay that price for one share. Remember, in options, you're paying $300, but you're controlling 100 shares. In stocks, you're paying the share price. You're paying $364.49 for one share. In stock, the market moves dollar for dollar. So if it go from 364 to 365, that's a $1 move. That's how much you made, $1. So in order for you to control 100 shares in stocks, you would have to multiply $364 times 100, because you want to buy 100 shares. 100 times 364, that's $36,000. So you'll need $36,000 to control the same amount of shares you get in stock options for $300. Do you dig what I'm saying? So that's the difference, people. Now, stock options are more risky because we have to worry about an expiration date. All these are your expiration dates. You're fighting against time. When you buy shares of stock, there's no expiration date. You can sit in that stock for 10, 15 years if you want to. There's no expiration date. But in options, you do have an expiration date. So your timing have to be on point and your analysis have to be right. Now, if you are an option trader and you're struggling, you're constantly losing trades because your timing ain't right, here's what you do. Invest more money and buy further out contracts. You might want to swing trade. Now, swing trade contracts are going to be a little more expensive. What you're doing is you're taking 0 days to expiration type of contracts, and you're not giving the market enough time to move in your favor. So what you want to do, instead of buying these type of contracts, go further out. Now they might be more expensive. You see, like 365 right here, That's $11. That's gonna be about $1,100, but you're giving yourself a couple of months. You're giving yourself 14 days. You're giving the market enough time to move in your favor. Now, Tesla is an expensive stock. I would look for a much cheaper stock, but I think you get what I'm saying. Or you can just buy shares of stock. You don't have to buy 100. You can buy 10, 20 stocks, whatever you can afford. And don't worry about expiration. And every 2 or 3 months, you could check out. And when the market retrace, you can get back in the trade again. Rinse and repeat. Do the same thing over and over and stack your bread like that. For example, let me go to my day time frame, my daily time frame. All right. Let's say I bought the stock right here. It went up. I'm checking out. You come back down. I'm getting back in. You go up. I'm checking out. You come back down. You come back down. Right here, I'm hopping back in, catching a few more dollars. You can grow your account like that. You don't have to worry about expiration date. The only problem is it's going to be more expensive to own 100 shares, but pay for what you can afford. Maybe you can buy 10 shares, 20 shares. Until you get to the point where you master the market and know how the market moves, then you can start buying options, you dig? So that's my advice for struggling traders. This your boy Leo from Stack and Grow Capital. Peace.